Welcome to IG's Trading the Markets. I'm Victoria Scholar. Coming up, we're going to look at the top traded cannabis stocks. Matt Bottomley from Canaccord Genuity told us about the key indicators for the cannabis sector.
I don't think the absolute numbers are as important as indications within the earnings of how execution is going. And if a management team says, 6 months ago we're going to be profitable in 2 quarters, if that time elapses and they're revising their guidance downward or not giving very clarity, that's more important than whether or not a company's doing, $2, $3, $4, or $5 million of EBITDA this quarter.
And Morgan Paxhia from Poseidon Partners spoke about where to find yield.
With mezzanine-like financing, for example, as Matt was mentioning, enterprise value instead of just market cap as a metric to look at because these businesses are able to access debt. Certainly much more favorable terms for the operators up in Canada, being federally legal there, but here in the United States, these multi-state operators still have to pay a pretty decent interest rate, especially compared to where just the global macro situation is of interest rates. We can still get some pretty attractive yields with warrant coverage, so the return profile is pretty interesting, and that's why you've seen a pretty significant amount of capital going in that direction.
To find out more, stay tuned to our podcast, IG Trading the Markets. Around the table today, we're here to learn about exactly how to invest in the cannabis industry, particularly through trading the big marijuana stocks on the public markets. This is quite a new sector and therefore potentially a bit misunderstood, which arguably could create some major opportunities. As we know, Canada became the first Western country to legalise the drug for recreational use in October of 2018. And in the months running up to that turning point, a number of the big players decided to go public. We saw flotations from the likes of Canopy Growth, Kronos, Tilray and Aurora. But the question for investors who want to get exposure to this sector is how to differentiate between those individual stocks, how to identify the buy and sell signals, and how to value the major players and spot opportunities in some of the lesser known, smaller growth stocks as well. So joining me on the podcast today to help us answer those questions is Morgan Paxhia. He's the co-founder at Poseidon Partners. This is one of the longest running dedicated cannabis investment funds with over $105 million in assets under management. I'm also pleased to say that I'm joined by Matt Bottomley, who's an equity research director covering the sector at Canaccord Genuity in Canada. So, Matt, if I could just start with you, Firstly, thank you so much for joining us. Matt, we know that each sector has its own valuation metrics. So tell us, what are the key ones to look at?
Yeah, thanks for having me. The cannabis sector, given the nascent stage and the fact that many opportunities out there still haven't inflected into profitability, it's a difficult sector for these rules of thumb, which I know a lot of investors like. So, one of the metrics is that's used, I think, pretty consistently across the board is an enterprise value to sales metric if profitability hasn't been reached, or potentially an EV/EBITDA multiple on some sort of forward basis. But I think before getting into that, you have to really understand what market the opportunity is in, because what's happening in Canada is vastly different than what's happening in the U.S. And other international markets. So rather than looking at a rule of thumb multiple, we try to look at sort of total addressable markets as to where these cannabis companies operate, and then discount back where we think those cash flows are going to come from. So there's no easy way to do it, and I find the more I look at this space, the more you're sort of forced to roll up your sleeves and really dig into the various regulatory frameworks that intersect with a number of these companies.
So can you talk to us a bit more about some of the financial models that you use to look at these stocks?
Yeah, so I've been spending most of my time over the last year or so looking at a lot of U.S. opportunities, and because it's federally illegal in the U.S., Schedule I drug, all the regulations are done on a state-by-state basis. So I'm from Toronto and live in Canada, and in Canada we have sort of one federal rule book that's done with sort of various intricacies more at the provincial level for distribution. But in the U.S., you kind of have to understand every market on a standalone basis, and some of the leading what's referred to as now multi-state operators out of the U.S. Are now in a dozen, if not almost 20 states. So you really have to look at the material states in terms of the opportunity industry and how we value most of these companies is we try and, for the most part, over the longer term, look at more of a top-down approach where we try and ascertain what's a reasonable or conservative market share that a company might get in each state based on how much, what the licensing framework is, how strong we think their first mover advantage is, what type of product forms are allowed and distribution models are allowed to sort of get everything back to an overall market share in dollars of every market. And then we do our best to try and risk adjust each of those markets and bring it back to a present value. So it's not an easy exercise. It's certainly a very subjective exercise, but you really have to have, I think, an understanding of the operating environments of where each company is rather than just take a look at their forward estimate and capitalize it or use a multiple, because an operator in Florida is significantly different than, let's say, someone in Oregon, and profitability can be very different in those markets, if not impossible in places like Oregon. So I don't know if that's the answer you're looking for, but it's more of a detailed exercise than just trying to find a multiple.
Yeah, I mean, Morgan, do you kind of echo that view that a lot of it is about the operating environment? I mean, how do you kind of go about trying to find those over or undervalued stocks? How do you find value in the sector?
Sure. So we've been in the space now for 6 years. We've looked at thousands of companies, and we've invested in over 100 companies over that time period, from early stage all the way through to public equities. So we get to see a lot of this industry in many different areas. We broke this industry down into subsectors early on. Understanding that their pathways, their profitability, their fundamental metrics would all look very different, but we were able to get a first-hand look by participating with so many different companies and so many different markets. And one of the things we learned early on is that, the only constant in cannabis is change. And so, it's hard to have hard and fast rules of thumb early on in this space. You have to be constantly adapting. There's so many variables coming at you, and which is pretty indicative, I think, of just an emerging market generally. What is more nuanced with cannabis is just the regulatory deviations between markets. In the United States alone, it can look vastly different state to state. And then, we do have federal countries or federally legal countries like Canada, and potentially the emergence of Mexico here in the not too distant future, which is very exciting. But those regulatory differences can have significant implications to the growth rates. We say it could be your greatest headwind or your greatest tailwind, meaning that it can really slow things down or accelerate things. At the same time, those regulatory dynamics can change. I mean, we've seen massive changes over the years where, say, if you are a packaging company or you are a product manufacturing company and all of a sudden they changed edible packaging requirements, without inventory financing, we saw a lot of early edible companies get wiped out. Because they couldn't get through that hurdle. So we really try to keep an open mind and continually evolve with the landscape. Capital flows are also a big determinant, where they can bid up valuations to very excessive area, like what we saw up in Canada, just unjustifiably high prices. And, the market has been slowly and painfully recalibrating and closing that gap to, as Matt was mentioning, some of these U.S. multi-state operators that still trade at a very much, very low multiple relative to some of these Canadian companies. So, we just got to make sure you're checking these companies, following closely. We've always had a belief of boots on the ground as being vital to truly understanding these markets. And so being immersed in these markets to understand if there is a positive change coming or a negative.
Yeah, I mean, Morgan, just to pick up on one of your points there, I mean, why do some of these big companies fetch such high valuations when, quite frankly, it doesn't really reflect in terms of the strength of their bottom line?
So there can be structural issues around with regards to the public companies. If there's a tight float, meaning if there's just not a lot of stock and there's like a big pile on from retail investors, there's not much out there to short or hedge, and so they can run these things up to just unbelievable prices that are just not sustainable. And we've seen that numerous times over the years. Just how the numbers are just getting bigger and bigger. one thing we always kind of pride ourselves on is, the big high-priced stuff that's just no interest to us. There's so much opportunity when you get away from the high valuation stocks that there are just, there's so much growth in this space, and there's no need to chase high prices when you can get great entry points in so many different ways.
Okay, so moving on slightly, Matt, we know there's a lot of focus on earnings season when it comes to investing in the stock market. So what are the numbers we should be paying close attention to in the cannabis sector?
Right. So again, it would depend on the opportunity you're looking at. Someone like Canopy or Aurora would be very different than someone that's in sort of one state in the U.S. But I don't think the absolute numbers are as important as indications within the earnings of how execution is going. And if a management team says, 6 months ago we're going to be profitable in 2 quarters, if that time elapses and they're revising their guidance downward or not giving very clarity, that's more important than whether or not a company's doing $2, $3, $4, or $5 million of EBITDA this quarter. And the reason for that is if you are trying to bet on the winners in this space, execution and the pathway for these companies to eventually crystallize some of the moats that they have in these various markets. So, you look at Trulieve in Florida that has about half 50% of the market share there. You want to sort of track how that company is continuing to execute, and even companies that aren't far along in their build-outs. You want to look for indications of that, because at the end of the day, no one's buying, or no one should be buying, these cannabis stocks for eking out profitability here. You want to make sure that the opportunities you're investing in are ones if you want to have a high valuation upside, are ones that are going to do tens and tens of million of EBITDA a quarter. Or if you're Canopy Growth, these guys eventually are going to have to be doing 500 million or perhaps $1 billion of EBITDA one day in order to justify longer term valuation. So whether or not a company is doing some nominal amount or slightly better isn't really a concern for me. It's tracking how they actually progress quarter over quarter, and are they doing what they said they were going to do, and is everything moving in the right direction with respect to their strategy. If things start having to turn around or things start needing to be revised, then again, even if they inflect, let's say, slightly into EBITDA positive or cash flow positive territory, if their overarching strategy isn't starting to crystallize, that's much more concerning to me than any sort of financial metric, given that we're in such an early stage right now.
So does that mean that the management team is absolutely crucial when it comes to these stocks?
Well, of course. I think you can say that for most industries, but particularly in an emerging industry where, unfortunately, with that comes a lot of promotion and people that are not necessarily even buying into their own stories, but they, latch on to some of these buzzwords. You'll hear, 1,000 companies out there say they have the best brand, or they have the best quality, or they have the best consumer insights, and some of them probably do. But you have to be very careful with respect to some of these buzzwords and some of the things out there that really, when you boil it down, don't provide any differentiation, just given how nascent the industry is and how disaggregated it is. So clearly management competence, one of the metrics that I look at that's very subjective is I get to talk to dozens and dozens, if not more, institutions in probably, another dozen cities outside of Toronto. And all of these companies are going around marketing, particularly the public company ones, off the back of a lot of RTOs that happened in the space last year and continue to into this year. And you get an indication of who's sort of buying what stories with respect to management competence, whether or not there's, conservatism in how they're branching out into various markets, how they telegraph when they expect their numbers to come in. It's a subjective exercise, but I certainly get feedback from all the accounts with respect to what management teams are, I guess, more believable. But it's a risky sector. You look at, for example, in the Canadian space, a company called CanTrust here just got their license suspended, and that was a company that came out very well. So you really don't know what's going on behind the scenes or behind the curtain, and it's difficult for someone like me in equity research, where I'm based out of Toronto here, and we of course do our due diligence and go around, but it's not a daily event we can do that. So I think as Morgan said, the boots on the ground presence and having an understanding of operations and in addition to confidence in management is very critical.
So, Morgan, what about the dividend? We know this is a difficult time to find yields around the world, with a lot of central banks continuing to lower rates. What are the payouts like in this sector, and what do you expect to happen to dividends going forward?
Well, there's really not a dividend to speak of in our space. for the vast majority of the space, right? I mean, some of these cannabis REITs, they pay a nominal coupon or dividend, but it's pretty much financed with debt right now because they're still in growth mode. So they're pretty far away from being self-sustaining in that regard. Where we do see interesting yield, though, is with mezzanine-like financing, for example. As Matt was mentioning, enterprise value instead of just market cap as a metric to look at because these businesses are able to access debt, certainly much more favorable terms for the operators up in Canada, being federally legal there. But here in the United States, these multi-state operators still have to pay a pretty decent interest rate, especially compared to where just the global macro situation is of interest rates. We can still get some pretty attractive yields with warrant coverage, so the return profile is pretty interesting, and that's why you've seen a pretty significant amount of capital going in that direction after 18, 19 months of a negative equity market for our space. People are gravitating to a little bit higher in the security, of the cap structure and getting a little bit more cash flow out of it. So it is an interesting play there. Just watching those companies that do over-lever themselves, or back to the management discussion, which teams are capable of being true stewards of that capital, because their assets tend to not cover these debts at this point, especially as a lot of them are offloading any of their hard assets to these REITs that are willing and ready to buy and do long-term leasebacks. So there, you do have to look at that, but for some companies, it can be a great lever to pull to bring in extra cash onto their balance sheets. And investors are being commensurately compensated for the most part. I mean, we're starting to see some single-digit interest rate deals getting done in our space in the U.S. We think it's way too early and far too risky to be getting anything less than 10%. Even with warrant coverage in the U.S., because we're still structurally in this time period where federal laws are still catching up. I mean, we are starting to see some progress on federal banking matters. This week there is a reading of the Safe Banking Act, which is very limited, but a step in the right direction.
So, Morgan, can you just explain to us a little bit more about your overall investment strategy?
Sure. We are growth investors at this stage of the cannabis industry's life cycle. As I mentioned earlier, we are constantly evaluating the landscape. So with our first fund, we took a very diversified approach. We explored many of the different subsectors, structures, type of investments, whether it was just preferred equity or convertible notes or mezzanine financing, real estate, just high yield debt, straight. And at this point, though, we are now focused a little bit more towards just the growth stage. So we're looking for companies that are a little bit more established and coming in with that growth capital to take them to that next step. We think it's a really interesting time in our space because institutional capital still is largely missing in the U.S., and we don't see that changing for some time. And these companies are needing these larger rounds of capital. And who are those sources of capital? And there's some funds in the space at this point, but relative to the size of the investable landscape, it still is an undercapitalized industry. And so we think it's a very attractive time to be investing in that part of the life cycle for at least the next couple of years.
So, I mean, Matt, do you see this more as a sector to trade in or more to invest in for the long term? Because we know that it's notoriously volatile, but, I mean, do you expect those gyrations to come down as the sector grows?
In terms of the long-term view, sure, it should be if the market, particularly the companies that are successful in this market, do reach semi-maturity in the states that they're in or the regions that they're in. And over the long term, this will be a very high-yielding sector, particularly if it is what I believe to be a consumer packaged goods sector, where I think users and buyers are going to be paying for brand, and I think that you can start to see commoditization curves kick in and the input costs will lower, and I think there's a lot of margin to be had for brand, but it's very, very difficult, if not impossible, to guess who those winners are today. So to answer the first part of your question, I think it is probably the most dangerous sector you could ever invest in, at least in my professional career, to trade in. I know a lot of people do, and you can be very successful in that. But my view is you have to look at it as an investment, because you look at what's happening in the valuations, even in the Canadian names here, they're off about 65% from only in March, and obviously there's some headwinds in the Canadian sector, and we need to see more retail stores open, we need to see more product breadth, but there really hasn't been a fundamental reason for such a drop, other than the fact that perhaps it was overvalued to begin with. And on the flip side of that, I think it was late 17, early 2018 when these stocks were moving 10% a day. The index literally was moving about 10% a day for a few weeks on the positive side, and of course there was nothing fundamental changing in those days to justify that. So it's an incredibly dangerous sector. We've seen a company like Tilray go from I forget the numbers now, but a mid-teen IPO price all the way up to $300 and then back again. So I wouldn't suggest anyone, unless it's a very thought out hedging strategy to trade in the space, unless they have a huge appetite for volatility and speculation. So certainly the long-term investment pathway is the way I would choose to look at this sector.
So Matt, what is your kind of vision for the sector in the long term, say over the next 5 to 10 years? What type of growth do you expect?
Well, I mean, there's a significant growth curve here, and when you look at the historical, illicit cannabis use in terms of people that might have smoked joints or bought dried flower, there is a relatively known demand curve. Of course, there is some subjectivity in there, but I think the real growth, or at least the more attractive growth for me, outside of just transitioning illicit into legal, is going to be what we don't know about users in this sector. There's a lot of medical applications that potentially could come out of the woodwork. There's a lot more R&D and investment that needs to go into this space, and the fact that you have one of the largest economies in the world, powerhouse of the world in the U.S. that has this listed as a Schedule I drug, it makes it extremely difficult for any traction to move there. So I don't think we might be talking about 5 or 10 years when it comes to rolling out all of the legal retail stores and all of the legal operators and maybe some online platforms, potentially product being able to cross state lines in the U.S. But I think we're looking at decades and decades of growth when it comes into really bifurcating the medical opportunity here. Because at the end of the day, when a patient's taking a medicine, you have to have consistency. You have to have real clinical trials in it. It can't be that, well, if you grow it in greenhouse A, you get this impact, but if you grow the same genetics and strain in greenhouse B, you get a different impact. I don't think smoking anything is a long-term alternative for medicine. So we really are going to see, at least in my opinion, over a much longer time frame of 5 or 10 years, I think a bifurcation of medical and recreational. But the way that I see this sector, sort of over that time frame that you outlined, is a lot of consolidation, a lot of losers in this space with respect to not being able to execute, and the winners I think are going to win big. I mean, I think that there's an easy argument to make that a company like Canopy, let's say, is overvalued. But in my view, if you take a 5-year approach or a 10-year approach and you say, what is the largest cannabis company in the world worth at that point? I think that valuation is going to be multiples higher than what Canopy is today. The question is that company still going to be Canopy? And that's why there's a lot of back and forth with respect to execution and what the different strategies are, in order to give investors confidence that a company like Canopy or whoever you're looking at does have an edge in what they're trying to do over one of their peers. So 5 or 10 years, I'm sure there's going to be a lot of 5 or 10 months this sector changes significantly, but I think the end game here is a cultural shift that's going to take decades.
Morgan, do you have anything to add to what Matt just said? And on the flip side, I mean, what do you see as the biggest risks?
So it goes back to the regulatory. The whole question around this industry is, I mean, it still is an if. I mean, a lot of people are starting to say it's when, meaning around federal legalization here in the U.S. and more broadly, just globally, as more countries are seeming to head in that direction. But the recent kind of vaping craze hysteria here in the U.S. It just goes to show that nothing is a done deal. There's always work to be done. And if we get complacent as an industry and we're not continuing to push towards sound regulatory policy and opening of markets, this certainly can have a stall out. And that is very concerning. We've come so far, but there's a still some very major mountains to climb here. And, everybody that is in this industry also should be advocates and politically engaged in helping to open up this industry in a thoughtful way. The biggest concern we see is overregulation, overtaxation, and the implications that can have, because that really does just facilitate a more thriving of an illicit market. And that's completely counter to the whole idea of legalization in the first place. We want to make sure there are good regulations, that consumers are safely consuming products, that they understand what they're consuming, that there's transparency in the process from testing, and that there's sufficient testing requirements of not just the cannabis itself, but if there's any additives or anything else mixed in, so people are just knowledgeable, and that these kind of hysterias are not tied to the legal market in our space. And that is being proven out a little bit right now, but just I think it's a great case study of that there still is work to be done. So that's a risk we look at, and certainly we are involved politically, and so we have a bit higher confidence that concern is currently in pretty good check. But we just always do caution the broader industry that doesn't mean to get complacent. Keep working, keep driving forward. The work is not done for, I think, easily another 5+ years, because even if we do get federal legalization, it's a question of when is the rollout, what is it going to look like, and this whole idea of interstate commerce. From our perspective, we wouldn't be surprised to see a very similar situation like after the end of alcohol prohibition, where you have very, very patchwork interstate regulatory situation where some states you can import and export to, some you can't. You're limited in what you can and cannot, and those have some pretty significant long-term implications. Like California could sufficiently supply the vast majority of the United States, and even some international, but that would have significant impacts to the billions of dollars that have gone into East Coast operations. So there's this all does tie in a lot of different ways, and so from our perspective, it takes dedicated focus to really understanding all of the different attributes to the space.
All right, well, that's all we've got time for in this episode of IG's Trading the Markets, helping us learn about how to invest in the cannabis sector. Thanks so much to my guests, Morgan Paxhia from Poseidon Partners and Matt Bottomley from Canaccord Genuity.